I'm Jeff Rothbart. I'm the head of investments at PeerRealty. We're a Chicago-based crowdfunding platform.
And I'm Amy Kirsch. I'm head of investor relations.
And we are here today to talk about the Cherry Creek Plaza in Homewood, Illinois. Cherry Creek is the latest offering on the PeerRealty platform, and we wanted to go through a little bit of a high-level overview of this stabilized retail community center offering. Cherry Creek is an 85% plus occupied retail center in the suburbs of Chicago. What we really like about this transaction is we think that this is a very good balance of stabilized returns as well as upside for the investors. We think that this deal is a 14 to 15% projected IRR over the life of the investment. We're offering investors an 8% in preferred return with a 70% share of the profits after the return of capital and an 8%. As I mentioned, this is a retail center, and it's part and parcel of a larger retail center with tenants that most of you will know, Walgreens, Starbucks. Now, all those aren't part of the offering. Those are strong retailers that indicate that this is a desirable location within the trade area for a retail center to be located. Some of our primary tenants include Ace Hardware, Bank of America, Panera, just to name a few. But as you can see by looking at the site plan, this center is very well occupied and there's very little vacancy that is left to be leased, and all of the remaining vacancy is the smaller units. The largest anchors, Ace Hardware and Lorenz, are leased. So the large spaces are leased, which is a nice thing, and as you can see, there's only one vacant unit. The Cherry Creek Plaza offering is being offered by Rothbart Property Management, which is a growing firm based out of Northbrook. Rothbart is acquiring this property for $7.1 million, of which $1.8 million of the equity will be raised by PeerRealty. The balance of the equity will be raised by the sponsors of Rothbart. One of the things that we really like the best about this transaction, as I mentioned earlier, we think that there's a really healthy balance of current cash flow because the property is 93% leased and potential upside. Most of that potential upside comes from under-market rents on the Ace Hardware and the Lorenz space. Both of those tenants are paying approximately $4 a square foot on a triple net basis. Triple net means that the tenant is responsible for the payment of all operating taxes. All property taxes, all operating expenses, and insurance. We think that conservatively the market rent for those spaces is $10 to $12. We think that the market rent for those spaces is more like $10 to $12 triple net, which means that we think we can potentially increase those rents by 250 to 300% over the life of this hold. In the event that that happens, there will be much more material upside to the investor than what we have underwritten. And so that's one of the things we like, is that we have not underwritten all of this upside. We've underwritten some of it, but not all of it. And that we think we can capture some additional IRR and equity multiple for our investors. This target hold for this property is going to be 5 to 7 years. And we think that this will be a great stabilized investment with some additional upside. The property is located in Homewood, Flossmoor. Homewood is located about 22 miles southwest of Chicago. Homewood has a population of just under 20,000. It's got excellent schools and is a phenomenal demographic area for retailers. And with that in mind, I believe that Amy has some questions from some of our PeerRealty investors.
I do. So maybe we can start with what the single best thing you like about this property and why we've chosen to list on the platform.
I think, Amy, that the best thing about the property is first of all the acquisition basis. We are buying this for about $100 a square foot. And one of the important metrics when you're understanding real estate is what is replacement cost? The replacement cost is what is the cost to replace this building if we had to build it again. Rothbart estimates the replacement cost is closer to $200 a square foot, which will put us in a strategic position to release these units should any of our current tenants vacate with good likely success. So I think the basis is the first thing that I really like. The second thing that I like is in relation to the basis, and as we've touched on a little bit previously, I think this is a very healthy balance of current cash flow, high current occupancy, but also potential upside. It's very rare that you see a well-leased retail asset that has the type of upside that this asset has. So I think that that's what I like best about the deal.
Can you talk a little bit about the valuation methodology used to come to those numbers, or what you looked at?
Sure. What we do here at PeerRealty that's a little bit different from some of our competitors is we don't just accept the sponsor's underwriting in totality and grade that on some scale. We take all of the bare bones numbers, the revenue, the expenses, and we put it into our own model. So to answer your question, we've underwritten this deal from the beginning. And we took our own numbers, we did our own analysis, and we relied very little on what was provided to us by Rothbart in coming up with our valuation.
And when you say we, can you talk about who actually does the underwriting?
It's a full team effort here at PeerRealty. Myself and our CEO, Jordan Fishfeld, oversee a team of analysts that help underwrite the transactions, but we all work together in conjunction. In addition, we rely on market experts and market brokers in any given locality to verify our assumptions and make sure that we are doing a proper job of underwriting these transactions.
Sure. With that in mind, we've seen grades on other websites. Why don't we grade at PeerRealty?
I think that I've seen the grading systems that some of the other companies use, and I don't know that those grades have any real correlation to the risk that goes into these assets and these investments. And so what we like is as I said, we underwrite the deals, and if we don't think that a deal underwrites or is a good buy, we won't put it on the site. A good example of this is I mentioned replacement cost. We're buying this at $100 a foot. I think replacement cost is plus or minus $200 a foot. If you were to buy this thing at $300 a foot, that is not a metric that would show up on any of these grading systems. And to me, that would be a reason not to do the deal, right? Buying it at $100 above replacement cost. And so we think that the grading systems are nice, okay? But we don't believe that they adequately reflect all of the fundamental aspects of real estate that need to go into evaluating a transaction.
Can you explain the fees that are charged to investors?
Sure. So under this transaction, and the fees are different on all of the deals that come onto PeerRealty, but on this transaction, there's only one fee that is charged to the investors, which is an annual asset management fee equal to 1.25% of the equity that is invested by Peer's investors.
And what about the multiple levels of returns?
So for those of you who watched the webinar that we did on IRR, one of the things I discussed was promote structures. Okay, and what happens in real estate is at certain return milestones, the sponsor, in this case Cherry Creek, earns a disproportionate amount of the gain on the transaction to the equity that they put in. So the multiple layers of returns show and demarcate when that disproportionate sharing of profits occurs. So on this deal, there's only two layers of return. There's the 8% return to our investors, and then there's the 70-30 split thereafter. Some deals have 3, other deals may have 1. This one happens to have 2 levels of the waterfall, it's traditionally called.
That's all the questions we had for you today.
All right, great. Thank you very much, Amy. It was fun, and we look forward to talking with all of you on the next webinar.